Hey guys, Rob Mitchell here. Thanks for joining me for day trading system profile secrets. What we're going to look at here is a way of kind of thinking outside the box or above the box, if you will, for your trading and the way you set stops and all these kinds of things. It's a vast topic of money management. And I had some questions today on this kind of stuff. And so I thought I'd cover some of this for you and kind of expand the way you think, like I said, thinking above the box, or outside of the box in a way that you have a vision for what's the bigger thing that you're actually doing when you're trading. This can help step up your game and take you to another level. Day trading system profile secrets, differences that make a difference. First off, past performance is not necessarily indicative of future results. There's a risk of loss trading futures. Don't use the grocery money for trading, please. It's better to live and be around tomorrow. And what we're going to discuss in this video can help with that. Now, this video could be a little bit dry and theoretical, but bear with me. If you can kind of get your mind into the mindset of the kinds of thoughts that we're doing, we're going to approach some things that have to do with trading psychology, but we're not going to go into trading psychology necessarily. But bear with me a bit. I'm going to go through this relatively quickly and take some screenshots or pause the video, etc. If you need to, okay? But bear with me because I think there's content in here that can really help you with your trading, okay? Albert Einstein said, you can't solve a problem on the level of a problem. Now that all sounds fancy and everything, but a real simpler way to put it is, it can help a lot if you're thinking at a level above where you're working at. This is why the CEO up on the top of the skyscraper gets paid the big bucks while the guy in the mailroom doesn't get paid diddly. Don't tell me that guy in the mailroom isn't like a smart guy. He is. He's got ideas, dreams, and aspirations, but they pay the guy up at the top the big bucks to go out for lunch and make decisions. Why? Because he can see, and that's why he's up there in that big view out over the whole city. He's thinking above, outside of the box, or like I said, above the box. So without further delay and kind of setting the tone with that, as traders, we often lose track of the big picture we're trading in, how we trade in the moment and how it impacts our bottom line. This is the counter statement to that, right? You go down the rabbit hole, you lose sight of what you're really doing. So this is a topic I've never seen anybody discuss this. So like I said, bear with me. There's some nuggets in here of truth and wisdom, knowledge, and understanding. So by being aware of that big picture, traders can avoid pitfalls that can cause failure even when a trader wins a high percentage of the time. There's several ways trading decisions we make can influence our bottom line. For example, first, the type of trading we do. Different types of strategies have different statistical profiles. In fact, I can look at a statistical profile of a trading system and tell you what it is. And you're going to learn that here in this video, okay? So for example, like if you're a counter trend trader, typically you'll be winning a pretty high percentage of the time, but your average trade might be smaller than the trades that trend traders get caught in. If you're a counter trend trader, you'll typically have a little higher win percent and your average trades might be a bit smaller. Now, as a counter trend trader, it's easier to trade from a psychological standpoint because you have what? A higher win percentage. In fact, I've been saying for years, a win percentage is the number one thing that you want to go after. We're going to talk about different ways that you can do that in a level above the box here. Counter trending can also have fairly small stops because you're trying to catch things at the edges. This can also help in the same way. So the trade-off for the counter trend trader is the ratio between the average winner and the average loser can be relatively small. This is not uncommon for a counter trend trading profile. Yeah, profile, that's the term I'm using here, right? Well, it's not uncommon for that. Say 75% of the time they win with an average win-loss of about 0.5. Yeah. So when they lose twice as much as when they win. 2 and 4 I have there in the example. Yeah. So in other words, the average win is only about half the average loser. The losers don't happen that often because you're winning 75% of the time. Yeah. So that's generally, when you see a trading system profile that's kind of like that, 75.5, yeah, it's probably counter trend trading system. Yeah. So there's a measure you can use to summarize the numbers like that, and it's called expectancy formula. Okay, I don't want to get too abstract here. Expectancy, probability of winning times the average win. Hopefully that makes sense. Minus the probability of losing times the average loss. What it's doing is it's taking both of those numbers and it's looking at both sides. It's looking at the winning side, probability of winning, average win, multiply, minus probability of losing, average loss, multiply, and take the difference. It's called expectancy. Yeah. So by fluctuating these numbers one way or the other, you can do all kinds of stuff. You want your expectancy to be positive, yeah, and you want your win percent to be fairly high so that you can continue trading. I find most traders in my years of teaching trading don't do well with trading systems that do not win a reasonably high percentage of the time. Now, a little note here. Okay, there's two general inputs. Another way of looking at this equation, right? There's two general inputs to the equation: the win percent and the average. Yeah, so you got the win-loss, right? So I generally recommend, this is the second time I've said this, get the first one first, get your win percent up. Focus on getting your win percent. I'm talking about, what am I talking about right now? Your journey as a trader. Get your win percent. Get it to an acceptable win level that works for your psychology. What is this? This is the journey towards your personal holy grail. Yeah. You get to an acceptable win percent and then start working on improving your win-loss numbers using a tool like trade markers, for example, from Indicator Smart. I'm going to show you some ways that you can bump up this game in a few minutes, okay? That you can fluctuate those numbers in that equation and that mathematical equation. What's a mathematical equation doing? It's looking at things above the box, right? So, for example, for the above profile, we'll expect to have something like 75 times 2. Those are the numbers we used before. 75% win and the 2 average win minus the 25% loss. That's 100 minus the 25, yeah, times the 4. And that, so you expect to make 50 cents for every dollar that you risk. Yeah, that's basically what it looks like. Yeah, and you can plug your numbers into that. Yeah. So traders who elect to trade trends we're on trends here, right? Can also do well, even though they're doing the opposite as the counter trend trader in some respects. So a trend trader will get caught in big winners. Yeah, sometimes many times the trend trader, many times the winner of the average loser. But they won't come as often. Yeah, won't win all, won't be winning like 80% of the time, but the average winners will be big. Yeah, so a trend trader may also go through periods of many losers as the market is in periods of consolidation. If you have designed a system or an aspect of a system, or have a kind of a system switching strategy, depending on the kind of environment you're in. I talked about that in the video I did previous to this one. Yeah, then you can really get into some serious kind of hybrid systems. I'll have more to say about hybrid systems in a minute. So markets might consolidate, 65, 70% of the time, that they're not trending, depending on the market. Yeah, so some trend traders might only win 30% of the time. However, the average winner may be many times the average loser, maybe even as much as 10 times. When you get caught in big trades, that's trend trading, yeah. Get caught in big trades. If you can get caught in big trades and you have, if you can get caught in really big trades and you have a high win percent, holy moly, that's a game changer. Yeah. So for the purpose of this article, let's say 8 times, 8 to 1. So we apply our formula there. I win only 30% of the time, but my winners are 8 times the losers, and I lose 70% of the time. I go 1.7. Which of these two systems is better? The other one was 0.5. This thing's a lot better, but the psychological aspects of this might be really hard to deal with. Yeah, might be. Like I said, I'm going to show you some ways that you can kind of change this around. So these numbers aren't intended for a comparison or of these two approaches. It's just an example. These aren't uncommon numbers, though, not that uncommon. So for both approaches could result in winning in the long run. Yeah, both of these had positive expectancy, didn't they? So so here's some of the pros and cons of each of these strategies without regard to time frame or anything else. Okay, I made a table for you. I'm going to show you in a minute. But before I do that, so you can actually combine these methods. I already mentioned this, trend and counter trend, to get what I call a hybrid system. And there's a whole bunch of different ways that you could do this. But when you do this, you can, for example, create a trend system with high win percentages and high win loss ratios. I'm going to make a little table for you and quad that out. Yeah, I'll show you in a minute. So this kind of hybrid approach is what we focus on in our trading rooms, for example, whether we mention it or not. That's what we're doing. We're trying to have a high win percentage with high average trade. That's what happens when you work on your win percentage first, and then you work on and get it up to a level that works for you, and then work on having the average trade be big over the average loss. So this is what that table looks like. So I got 4 quadrants here. Quad systems are a very helpful way of understanding being above the box. Yeah. So what do I have here? I got trend in the top there, and I got, okay, low win percent, high win loss ratio to the right. And I got counter trend, high win percent, low win loss ratio to the right. Yeah. You could also have counter trend conceivably and go on the diagonals in this box. You know, you could, but in a hybrid system, it's an approach that tries to flip-flop the two right boxes to be, instead of low win percent high and high win percent low, I want to get high. Yeah, I want to get high win percent, high win loss ratio for the best of both worlds scenario for counter trend or trend trading. Yeah. So counter trend trader in general, I'm just going to go through these real quick. Yeah. Smaller average trades over time, just in general. Trades often can have high expenses from commissions and slippage, tends to be more consistent in a period of time, or may seem to be more consistent in a period of time. People that do this, they could go like 2 weeks, win, and then blow the whole thing up in a few trades. Yeah. Oh no. If you've been around the block a few times, you know what I'm talking about. Okay. Can sometimes recover from drawdowns more quickly. Possibly. Requires less patience. You're not in trades as long, generally speaking. Smaller, you could have smaller stops with this conceivably. Usually the trend trading are bigger stops. Yeah. More exciting, more actively engaging. Engagement is a really big issue with all this stuff in finding your personal holy grail. You got to find the trading strategy that keeps you engaged in the process such that you can actually do it and not get distracted. Yeah, so I can often tell the strategy is working sooner and in less time, psychologically easier in many ways. Could be, but then there are pitfalls too. Yeah, it's a double-edged sword. Okay, for the trend trader on the right here, yeah, gets caught in big moves, trades less frequently, conceivably, because the trades last longer. Yeah. Has lower cost, lower commissions, can have long sequences of trades that are losers. Can take a long time to recover from drawdown just because of the way it's scaling. This all has a lot to do with scaling. You know, in time. Could require more patience, bigger stop loss, less exciting, more passive, less engaging. You often, depending on the way something like this scales out, it could even be years before you know if it works. Yeah. Now these days with the market volatility we have, like, market moving like 100 handles a day and stuff like that. You should be able to, and that's like a different topic altogether, but you should be able to know whether or not your system is working in a much shorter period of time than the old days where you could actually trade a system for years before you know if it's working, upon which the market changes and then it doesn't work anymore. So this volatile environments that we actually have these days is actually better in that way. Huge topic there too, could write a whole book on that. Might be psychologically harder to do because you go through long sequences of losers and low win percent, etc. Yeah. Okay. So as you review that list, you might plug yourself into those various traits and decide, well, what might work better for me? And you just sit there with a cup of coffee, just thinking about, And in so doing, you'll actually plant some seeds in your mind for what kinds of things that you like when it comes to trading. I want it all. Give it to me. I want it all. I want it the way I want it. No other way. The market must comply with my wishes. Good luck with that one, right? So, as always with trading, however, there are other factors that can impact you. For example, if you're trading one lots and you're counter trending, you may have a tendency to take your targets, getting out of trades at a profit. Might feel good, but if you start capping your winners at small numbers and have your win-loss ratio is not very good. That's what I mean. You can blow up in a short period of time. You go winner, 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 and then you have big losers. Yeah. So what can happen to you there is you end up winning a large percentage of the time, but the occasional big losers and trading expenses make you a break-even trader. Oh no. Oh no. This is why you want to be thinking above the box. So one lot traders, trend traders, of course, are less subject to this kind of thing. There's generally better strategy for the small trader to be a trend trader. In general, my experience, but then the problem there is you got to deal with lower win percentages and etc. So of course it's hard to implement because you have to stay with the trades for long periods of time. And if you're a screen trader, a day trader, screen trader, this can be a difficult thing psychologically, and it can make it difficult. So what are we looking at here? We're looking at two sides of each of those strategies, and I'm just kind of like plugging you into things that are in the table there. So if you're able to trade multiple contracts, you can really get into a hybrid kind of situation with that. Like we got guys in the trading room, I trade like a 10 lot, take 8 contracts off, at 5, 6, 7, 8 ticks or so, and then let the other 2 run, and you can get in these big giant trades. So then you can, doing that, you develop strategies to take shorter counter trend strategies, but also keep portions of your trades to stay with the trades that end up being runner trades, runaway trades, you could call them. So this can happen if it happens about 30% of the time, like in our example. If you recall the assumption estimate that we did earlier, we're 70% of the time consolidate, right? Kind of placing it into the market and things like that. You can try to let the winners run with a portion of your original position, and this makes kind of a hybrid strategy for money management that can balance trader psychological issues that can lead to success. What's the problem with it? If you haven't gotten your win percent high enough yet, and if you've gotten your win-loss ratio, you could, before you figure out whether or not what you're doing works, you could be in trouble. This is why I have the trading room and a lot of people in the trading room learning these things. And you need to give yourself the flexibility to do it. I recommend start small. If you can't run a small business, you certainly can't run a big one. So this kind of thinking leads to a second point I want to cover about trading and aligning ourselves with the big picture in a way that can increase the likelihood we'll win in the long run. And this has to do with trade distributions. I'm going to step up the thinking outside or above the box to another level right here. Trade distributions. Yeah, this is a form of statistical analysis, but it doesn't have to be. It can just be like, you can look at like the shape of things. Okay, but I'm going to show you in a minute. Yeah, analyze trades over time, which enables you to make better trading decisions. I find doing this graphically is a lot, because I'm an intuitive kind of person. It's my natural tendency. Yeah, I do math, but I need to understand things intuitively for me to do them. But my educational background is in, hardcore left brain logic kind of stuff, right? So, we're going to do it with a graph, okay? And so the most basic sort of distribution, the one most statistics is based on, is called a bell curve. Hopefully you're familiar with that. If not, you can pause the video and you can search that bell curve. Yeah, that's when the mean, the median, and the mode are all the same. Okay, it's what would happen if you flipped a bunch of coins, or dropped grains of sand in a pile. It would make a shape like that. Yeah, just dropping a bunch of sand in a pile from the same point. Drop, 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 drop. Yeah, those are going to make what's called a bell curve distribution. The whole field of statistics is based on this idea. Do financial markets move like that? They don't. But most statistics are based on this. Okay, this is why we use Bayes' theorem and stuff like that. So that's a whole other thing. Okay, so this is similar to a trading system or approach. What happens generally is you're going to get many sequences in trading that are small winners and losers. In other words, they're going to cluster around the middle. I'm going to show you in a second. Hang with me. So you'll do that clustering in the middle near $0, and when you occasionally get big winners and losers. Okay, so if you plot the sequences, you're going to get what's called a frequency distributions, fancy word for dropping the sand in the pile, but the sand that you're dropping is your trades. Without any stops, it might look something like this. Okay, going off to the right are the losers, and going off to the left are the winners. Yeah, so this trading system, what does this trading system do? It takes a whole heck of a lot of trades. It takes 1,400 trades that break even. It takes 2,000 trades that make 250 bucks or lose 250 bucks, 1,000 each. Yeah. So this whole graph nets out to $0. This is a trading system that just doesn't make anything. Yeah. It wins, it loses, and actually, for a lot of people, this might be a good thing. Yeah, might be. Here, I'm going to show you what happens if we cut off a side of this. So, in this thing, we got 5,500 trades on there. We didn't use any money management. It's just long, short, whatever. Yeah. And the trading approach is break even. Yeah. The left is equal to the right. The number of winners and losers is evenly distributed. We can tell this more or less by looking at the shape of the curve. Yeah. Shape of the curve. It goes up, it comes back down the same way. A little peaky in the middle, yeah, a little bit. And so it's even. So in financial markets, we usually don't deal with normal distributions. We deal with called skewed distributions. Like I said, I'm not going to get into that. But for now, we'll just use normal, yeah. And so, because financial markets are not random. Dropping grains of sand on a pile, that's a random, yeah. It's just like, okay, the sand hits the top of the pile, goes to the right or it goes to the left. Yeah. Or, falls to one side or the other. Yeah. So as mentioned, markets consolidate a good part of the time, and then they make these big explosive moves. This is why trend following that we discussed earlier can work. That's how you can get a trend system that, the average winner is 8 times the loser. You only win 30% of the time or something like that. So how can we take this kind of knowledge and shift it into something that can really work for us? And based on your personality and things that work for you. Yeah, you get how all these points I'm bringing up kind of come together as one thing in your mind. And if you can think above it a little bit, it can really make a big difference for you. So in the middle of the curve, we had about 1,400 trades break even. And then on the outside of the curve, we got a couple $3,000 winners and a couple 3,000 losers on the right. And it's just evenly balanced. So as traders, we can shift this distribution by placing a stop loss order on our strategy. Ideally, this would chop off a portion. And I say ideally, you should underline ideally, right? Because what will happen with these things is you stop yourself out and it ends up being a winner. But we're just doing this theoretically here. Yeah. So ideally, there's a chop off a portion of losing trades on the right and would cause the distribution to skew to one side, the plus side. Yeah, we're going to win. So if we had an ideal world and place a stop loss at say $500, the curve would look like this. It chopped off the right-hand side with the stop at $500. The bigger that stop is, by the way, the more likely it is that it's going to do this. And then what do you have here? Okay, I got two at 500, a winner and a loser. I got two at 250, a winner and a loser, and I got a bunch at 0. So if I take all those, 1, 2, 3, 4, 5 of them, and chuck them in the trash, then everything to the left, that 750 forward, those that's how much I make on this system, because the rest nets out to 0. So everything to the left of the 500 plus on the left there is profit. No, got that? You want to know what's interesting? I'm going to just throw this in on the side. This is a whole nother subject. If you've got a trading distribution like this and the shape starts changing, it tells you that your system is changing or the market's changing, one of the two. Yeah. As the market's changing and the way your system's responding to it is changing. And very often changes in a distribution like this can tell you that your system's failing before it does. Whoa. But that's a little bit more advanced. So we're not going to go there in this. So now that we've theoretically done this, we removed all the losses and the larger and made this approach really profitable. Yeah. This is a trend trading, isn't it? Yeah. Got a bunch of big winners that go way out into the tails. We didn't block them off by taking profit with a target. $2,500 winners, $2,000 winners, $1,500 winners, etc. Yeah. So we already talked about this. You get stopped out and then it becomes a big winner. Oh no, right? So we're just doing this theoretically. This will cause the overall curve to change and most likely be less profitable, but it may very well be profitable by placing the stop loss there. And like I said, the bigger that is, the more likely it is that it will be successful and get caught in those big winning trades. So this whole thing that we're discussing here is the essence and the simplest form of designing a trading strategy or system is like super important concept for traders to understand further, because we did it more or less exclusively with a stop loss order. It'd actually be more accurate to call this a money management system. We took a random system and we made it profitable by money management. Whoa, that's very different than trading signals, isn't it? Yeah, hopefully you get that concept. Yeah. So in my experience, most successful trading approaches are just this, a way of managing risk on an ongoing basis. I said it in the trading room today, I was kind of reminiscing. I used to say, with trading, I'm waiting for a good accident to happen. What am I saying when I say that? I'm saying, yeah, I'm a great guy and everything, but I'm not winning because of me. I'm winning because I'm putting myself into a situation where these things can happen without me losing too much in the meantime. Yeah. A lot of times after the fact, looking back, that's what trading can look like. Now, if you've got like a super system or something, that's a whole game, that's a whole nother animal. Yeah. But I'm talking about something that's relatively close to random. Trading systems. Okay. This is also one of the biggest misconceptions for most beginning traders, that successful trading is risk management. Yeah. Because beginning traders are very often closer to this random thing. Yeah. So they think they're like looking for signals. Well, What did I tell you from the beginning? You got to focus on your win percent, and then you focus on your win-loss ratio. And the stop might have something to do with that, yeah. Well, for this example, all we did was put a stop in there. We had made a profitable system that was random by the stop alone. It's worth thinking about, yeah. So there's another issue going on here. As we move more to the right of the distribution or the more to the left, we have progressively less control of the result of the trade. This is true because you do not get market moves of $3,000 very often. Oh, what are we looking at now? Oh, we're looking at the way our system interacts with the market and how likely it is that you could get a $3,000 move, which has nothing to do with the system. At some point, it probably makes some sense to take that $3,000. Yeah, etc. So you got multiple things that are interacting here, right? So the further out we place the stop on the right side of the curve, the more likely it will be that it will improve our strategy's performance. And then you could also have some kind of a trail or something, conceivably. You could try to improve it that way. There's all different kinds of things you could do. We're not talking about specifics of trading systems here or money management systems. Yeah. So we began this presentation talking about trend-based and counter-trend-based approaches. So let's contextualize this a little bit more, and then I'm going to finish this up. Okay. The curve that we've been looking at here might approximate a strategy that's close to a trend following approach. Well, we said that. And where we get caught in a number of big trades, we got a lot of trades clustering around the break even to small losers. Yeah. A counter trend approach would likely reduce the losing side of the distribution. Now think about this. I'm going to flip this on its head a little bit, the right side, because a counter trend approach would tend to buy closer to a market low or high and might have smaller stops, theoretically, yeah. In exchange for this, it might get out a bit sooner, and it might not then capture $3,000 winners. Yeah. So what you're doing for this case is you're going to try to control the right side of the distribution by winning more and not necessarily like stopping as we did with the trend example. Yeah. So a counter trend, you could say from that, oh, well, a counter trend approach is less like a pure money management and more like a trading system, trading signal approach. Yeah. You could sit down with a cup of coffee and think about that for hours. Yeah. If you didn't get that, watch this another time later, or, come back and watch it later, or pause it and think about it. Yeah. A lot of food for thought there. Okay, so because counter trend approach will miss the big trades by taking targets and things like that, this can make trading a bit riskier when compared to the trend trading. It could, yeah. And the big picture that we cannot see in the trading moment. That's why I'm saying this big picture. We're trying to get above it all here so we can kind of understand, what are we really doing when we're trading? Are we being successful because of our stops? I hope not. That usually doesn't work out very well. In all my 30 years of developing trading systems, I never saw a stop really improve a system. Not a fixed stop anyways. So a successful money management strategy will need to take into account how much total risk you have and can tolerate before you have to shut down trading where losses exceed levels, forcing a trader into margin calls, etc. So as a result, any money management approach must take into account a large number of variables in order to be successful, ultimately. Oh no. Each trader should keep good records and statistics on his trading so he can establish what? Trade distributions. If you've nodded your head a couple of times in this discussion, I am now telling you that the way to do this is to keep good records. I'm going to tell you something in a minute. Okay. By doing this and using some of the concepts we've been talking about, a trader can make better decisions that'll keep him in the game in the long run by knowing where we are in the big picture, even though it's this abstract Einstein level of the problem kind of thing that we started this discussion with. And if we understand that bigger picture, we're better able to stick with our trading plan and have a good mental state as we go through the capital alternations. Wow. Yeah, because we understand where we are, even though it's this abstract thing that you can't put a coat of paint on or anything like that. So we had a trader in the room. Actually, we have a lot of traders that have done this since. I came in the trading room, was there for a year and a half. Yeah, he logged every single trade he ever did, and he pattern classified it. Okay, is it this kind of trade, that kind of trade? 1,500 trades in his spreadsheet. He sent a spreadsheet over to me one time. We talked about it in our room quite a bit. This is years ago. Yeah, we have other members that do this on an ongoing basis. Thousands of trades logged in a spreadsheet and pattern classified and sortable. Yeah, this fellow went on to become a hedge fund manager. Yeah. So, can this stuff change your life? Sure it can. Yeah, but you got to do it. So, if you like this video, subscribe to the channel and like the video on the channel. Subscribe to the channel so other people can enjoy this stuff too. Yeah. All this stuff that I do this video in the spirit of sharing. Yeah, in the spirit of sharing. If you, and this is the philosophy of any of the business that I do, okay? Indicator Smart, Stock Index Trading Room, Oil Trading Room, and Manifesting Your Future.guru. I'm going to tell you about that. Okay. So we talked about psychology a little bit, psychology of trading in this article. So if you need help, if you've got things going on in your life that limit your beliefs about what you can achieve, Manifesting Your Future.guru. Okay. If you have things that are in conflict, values that are in conflict with your trading, let's say you grew up in a house where you were taught that you're working for the man. Yeah. Manifesting Your Future.guru. Okay. If you have negative emotions that keep you from being able to think clearly while you're trading, Manifesting Your Future.guru. Nobody does this coursework and does not receive a personal, misspelled that, transformation. It's guaranteed. Okay. It's guaranteed. So, all right, guys, I want to thank you for joining me for this video. Thanks for sticking through to the end here. By the way, Manifesting Your Future.guru, special coupons available for room members. You can reach out to me through the websites. Yeah. If you need to, and join us at Stock Index Trading Room or Oil Trading Room and learn more at Indicator Smart about all these things. Yeah. So, all right. That's what I got for you today. Thanks for joining me. Thanks for sticking through. Hopefully a couple of these things planted some seeds in your mind about how you can be a better trader. Yeah. Thank you. And we'll see you again on the next one.